President Donald Trump's renewed push for sweeping tariffs on Canada and Mexico has ignited fresh economic concerns, with industrial leaders warning of inflationary pressures, investment declines, and supply chain disruptions. Among the most vocal critics is ABB, the Swiss multinational specializing in industrial automation and electrification, whose CEO, Morten Wierod, cautioned that the tariffs will increase prices for everything and hinder investment. This intervention is more than corporate self-interest. It is an urgent signal from a global industrial powerhouse that protectionism may undermine, rather than strengthen, the U.S. economy. The tariffs, which include a 25% levy on Canadian and Mexican imports, come at a precarious time. Inflation remains a persistent concern. Energy markets are volatile, and manufacturing demand is fragile. By escalating trade restrictions, the administration risks creating a self-reinforcing cycle of rising costs, supply shortages, and retaliatory measures from major trading partners. But the implications extend far beyond manufacturing. The energy sector, already facing disruptions from global commodity price swings, stands to suffer significantly. Tariffs on Canadian oil and electricity imports could drive up energy costs, creating a paradox where a policy aimed at strengthening U.S. industry may instead weaken its competitive position. As a result, the U.S. may soon face higher electricity bills, strained diplomatic relations, and mounting economic uncertainty. History offers clear lessons on the inflationary effects of protectionism. The Smoot-Hawley Tariff Act of 1930 exacerbated the Great Depression by stifling global trade, while Trump's 2018 tariffs on steel and aluminum led to higher input costs for American manufacturers. The economic logic remains unchanged. Tariffs act as a tax on domestic consumers, not foreign exporters. ABB's warning reinforces this reality. The company, which produces 80% of the goods it sells in the United States domestically, is nevertheless alarmed by the tariffs' potential to drive up the cost of raw materials, disrupt supply chains, and make U.S. businesses less competitive. Tariffs do not operate in isolation. They create ripple effects that raise costs across multiple sectors. This time, however, the stakes are even higher. Unlike previous tariff waves that primarily targeted industrial materials, these new measures extend into critical infrastructure, including grid equipment and crude oil imports. Energy is the lifeblood of an economy, and artificially increasing its cost risks triggering second-order inflationary effects that will extend far beyond the manufacturing sector. The United States depends on Canada and Mexico for critical energy supplies. Canada alone supplies over 3.8 million barrels of oil per day to the U.S., making it America's largest energy trading partner. Mexico, meanwhile, is a key supplier of refined petroleum products, natural gas, and electricity to U.S. markets. By imposing tariffs on energy imports, the administration is weaponizing trade policy at the expense of energy security. Analysts warn that these tariffs will increase gasoline and diesel prices. Higher tariffs on Canadian crude raise refining costs in the United States, translating into higher fuel prices for consumers and businesses. They also strain electricity markets. The U.S. Midwest and Northeast heavily rely on Canadian hydropower to meet growing electricity demand. Tariffs on grid equipment and electricity imports will make power generation more expensive, directly countering efforts to reduce energy costs. And of course, they could trigger retaliatory measures. Canadian officials have already threatened counter-tariffs, which could further destabilize trade relations and disrupt cross-border energy flows. The irony is unmistakable. While the administration promises lower energy costs, its trade policies make them harder to achieve. ABB's decision to expand its U.S. operations with a $120 million investment in electrical equipment production reflects a broader trend. Manufacturers are reshoring operations to reduce dependence on volatile trade policies. While this may appear to align with Trump's America First doctrine, the reality is more complex. Investment diversion. While some firms will shift production to the United States, many will redirect investment to Europe and Asia, where trade policies are more stable. Supply chain disruptions. Higher import costs will make certain U.S. industries less competitive, particularly those dependent on foreign raw materials and intermediate goods. Capital flight. With uncertain trade conditions, foreign direct investment in the United States may decline, as businesses seek more predictable regulatory environments. The net effect is a fragmented global trade landscape, where companies are forced to make investment decisions based on political considerations rather than market efficiency. Adding another layer of complexity, a new report from the Carbon Majors database reveals that just 36 companies accounted for over half of global greenhouse gas emissions in 2023. The findings underscore the challenge of reducing emissions in a world where state-owned fossil fuel giants dominate the energy landscape. Yet, instead of implementing policies that accelerate the clean energy transition, Trump's tariffs target key energy infrastructure and renewables. The United States imported over $110 billion in fossil fuel, electricity, and clean tech from Canada alone last year. By restricting trade, the administration risks slowing progress on emissions reduction, while simultaneously prolonging dependence on high-cost fossil fuels. From a strategic standpoint, these policies contradict one another. The United States cannot simultaneously pursue energy independence, lower prices, and industrial competitiveness, while undermining its most reliable trading partners. Despite these challenges, Trump's tariff strategy is not an outlier. It is an extension of protectionist trends already set in motion. Under President Biden, the United States imposed tariffs on Chinese electric vehicles, steel, and aluminum, signaling a departure from free trade orthodoxy. But Trump's escalation takes this to another level, forcing trading partners to respond in kind. If Canada and Mexico impose retaliatory tariffs, the result will be higher prices, disrupted supply chains, and investment uncertainty across North America. The question now is whether the United States can sustain long-term economic growth while prioritizing short-term political wins. As ABB's CEO rightly warns, tariffs create an inflationary environment that penalizes businesses and consumers alike. The administration's latest trade actions will increase manufacturing and energy costs at a time when inflation remains a concern. They will strain relations with key trading partners, potentially inviting retaliatory measures, and they will undermine efforts to lower energy prices, contradicting the administration's stated goals. If history is any guide, protectionism rarely delivers its intended benefits. Tariffs may provide short-term political victories, but they come at a steep economic cost, one that businesses, consumers, and policymakers will have to reckon with long after the trade war rhetoric fades. In the end, the administration faces a choice: double down on isolationism, or embrace a more strategic, rules-based approach to trade. If it chooses the former, the costs will be borne not by foreign competitors, but by the very industries it claims to protect.